All right, so last class we looked at preparing the income statement as part of our lesson on preparation of financial statements. Today we're going to do the balance sheet, and it's based on the same question that we looked at last class. So what I did is I copied the question onto this page, but just as I introduced the last question, or the approach to the last question, we want to take that same approach here, which is to identify the figures that we are going to be using in our balance sheet. All right, so let's go through the figures. We just want to make sure that we're not missing anything. So in the balance sheet, we are actually capturing the assets, liabilities, and the capital of the business. And what it should show to the viewers of the balance sheet would be what the capital was at the start of the period and how that has changed during the period. And this is usually due to a result of what we would have earned in profits, or probably lost in terms of losses during the period of the for which we are preparing the accounts. So let's go through the balances. So building at cost, this is an important figure here, right? Because this is the building at cost, and we have some working to do here. So this is our, if you look at it here, if the building costs 210,000 and we're currently at 160, what that is telling me is what the total depreciation was to date, right? And then we'll have depreciation for the current period, which I believe we worked out last time. I think the buildings we said was 5,000. See it? So you see, when we're doing depreciation, we need to incorporate what we would have charged in our profit and loss account, along with the total depreciation that has accumulated so far in the life of the asset. So let's make a note of that one time. So workings, we have provision for depreciation for the building, and this is a balance sheet figure, right? Our balance sheet figure is going to comprise of two things. It's going to comprise of the depreciation accumulated to date, meaning up until now, plus depreciation for this year, right? Now, the depreciation accumulated to date, I mentioned, is the difference between the cost of the asset, which is 210,000, and what we listed it as in our trial balance at the 30th of September 2005. So it was listed at 160,000, and the depreciation to date would be 210. Right? Minus 160. That should tell us what our depreciation would have been accumulated to date. Right? Yeah, calculate, okay? So 210,000 minus 160,000, that's going to give us a total of 50,000. Right, so let's just read back to what they said in the question. So our French has been in business for 4 years. The following is his trial balance at the 30th of September 2005. Right, so we have the cost of the building, and they're telling us that our provision or our net book value as at the 30th of September is 2005. So that's an important thing for us to note here. The dates is important when we're paying attention to balances. So if you guys remember, let me just go back to the question. In the notes of the previous question, they told us to depreciate fixtures by 15% on a reducing balance basis, and that the depreciation for buildings was $5,000. And this is what we charged for depreciation inside of our business, right? This is what we charge inside of our profit and loss account. Now, this figure that I'm looking at here today, right, which is my buildings as at the 30th of September 2005, is my what we call the net book value. So this figure of 50,000 is actually the depreciation to date. I don't need to add anything to it, right? Because the cost of the asset was 210,000. And currently at the 30th of September, is it 2005? 2005, this is what the asset is worth right now, right? So my depreciation accumulated up until this period or this date is $50,000. So notice that I am not putting 5,000 inside of the balance sheet, but rather I am putting the total depreciation in the life of the asset. That's what's going inside of the balance sheet. Why am I doing that? Because I want to accurately reflect the value of the asset. I'm being prudent, right? I want to accurately reflect the value of the asset. So let's take, for example, a car. When I purchase a car out of, let's say, the showroom, I just bought the car, right? As I use the car over a period of time, the car is not going to be worth the same value as it was when I initially bought the vehicle. Does that make sense to you guys? As I use the vehicle, as I use the car, if it's a truck or something I purchase, it's going to reduce in value. So it means that I am not going to be overstating the cost of my asset inside of my balance sheet. I need to put it at a realistic price as to what it is worth now. Understand? Everybody okay with that? Just give me a thumbs up if you are. Nice. Good. Raise your hand if you missed what I said or you want me to repeat what I said there. Okay, Sarah. So with assets, when we are recording assets or we are reporting assets inside of the balance sheet, we have to report it at the cost of the asset currently, not at the cost of the asset or not at the price that we purchased the asset 5 or 6 or 7 years ago, right? Because that means we'll be skewing the information, right? If we purchase an asset, let's say we have a fleet of trucks, right, that we do deliveries with, and we purchased those trucks 5 years ago, and they were worth 200,000 5 years ago. I've used the trucks for 5 years. So that means it would have accumulated some degree of wear and tear on the trucks. So the current value of the trucks, if I was to take a value it and value the trucks, might say, well, you know, these fleet of trucks now worth $110,000, right? Because why? We've used the trucks over a 5-year period. They have accumulated some sort of damage and wear and tear on it. So now the trucks are not worth the same as it was 5 years ago. So inside of my balance sheet, I have to report the value of these vehicles as they are currently. Otherwise, I will be misleading people to think that a 5-year-old truck is worth the same price as it was. A better analogy might be, you know, let's say you purchase a phone, iPhone, and you use the phone for 2 years or something. The price that you paid for the iPhone 2 years ago, if you have to sell it now, you obviously not going to get the same price. Why is that? Because the phone would have depreciated in value. There are newer models, right, with newer features. Your phone would have gotten some wear and tear on it, right? You're not going to be able to get the same value. You cannot value the phone the same as it was 2 years ago. Make sense, Sarah? Right? So with that in mind, my first section of my balance sheet, I will always list my fixed assets. Some textbooks or some teachers may also refer to this as non-current assets. All right, anyone is fine. In this section, I'm using 3 columns and I'm going to be listing assets at their cost. I'm going to record what the total depreciation is to date for the life of the asset, not just what was charged this year, but total depreciation throughout the life of the asset. And then finally, just 1 second. Excuse me, are you recording? Yes. Yes. The recording is on, yeah. It's recording. Yeah. And then finally, in the last column, I am going to be reporting what we call our net book values, like the present value of the vehicle or the building or the asset, right? So this asset of buildings is currently 160,000. The cost, let's record it one time. So buildings, its value or the cost is in here, 210,000. And the net book value is 160. In order to go from 210,000 to 160, we are subtracting depreciation with or depreciation in the amount of $50,000. Everybody right with that? Right. Good. So we're normalist. So we finish with this. I'm going to call it take care fixtures at cost. So we can list the fixtures here one time. Now my fixtures at cost is 8,200. And just like the building, I'm going to have to charge some sort of depreciation for the life of the fixtures, and then I'm going to get the net book value. Now this one is a bit different to our building. Notice they gave the fixtures at cost. This is how much we paid for the fixtures when we initially received it. Everybody know what fixtures? What are fixtures? Yeah, everybody good, right? That's like a shelving and you know, you go to a store and they have like racks to put things on, the cash and counter, right? All of those type of fixtures and fittings, as we refer to them when we recording it in our accounts. So our cost is 8,200. This provision for depreciation for fixtures, right, 4,200. We have to add to this year's depreciation, right? So depreciation for this year, if you go back to our financial statement, right? We worked out what our depreciation for this year and fixtures was, and it was $600, right? So this is being added to our provision for depreciation here of 4,200. So it's actually going to be 4,800, right? Because we have to work out depreciation. And the difference between those two is what is going to give us our net book value, 8,200 minus 4,800 is $3,400. Right, so in this section, we want all of our fixed assets. Let's just take a quick run through and see if we have any other fixed assets, right? No accounts receivable or debtors, these are current assets. Creditors is our current liability. Cash at bank is our current asset, right? This is our opening stock. We're not going to be using this inside of our balance sheet. Rather, we need our closing stock, right? Our closing stock would have been given in the notes of the last question here. Stock at the 30th of June 2005. Right, 30th of June 2005 is 74,210. That's the figure that we're going to be using. So you need to make a note of that. 2, closing inventory. $74,210. Right? So we're going again. Sales and purchases, we're not using this. This is on our balance sheet. Not using this, not using this. Loan interest as well in our balance sheet. All of these things were for our profit and loss, sorry. Right? These two figures, we actually need to use this to subtract it from our total debtors here. Right? So this is going in our current asset section. Loan is going as a long-term liability, where capital is capital. This is going to be subtracted from capital. I don't need this, I don't need this. And this also here, net profit, which we got from our income statement, has to go to our capital. So there are no more assets. Everybody agree with that? No more assets. Now, I just want to put a pin here in this, right? Reason being, looking at the dates, seeing 30th of September here, and then when I was checking back here, I'm seeing 30th of June, and I'm seeing 30th of September 2004. That would have been the opening stock. Right, so we just put a pin here just in case we needed to add that $5,000 worth of this provision for depreciation, 5,000. Right? So now we would use the figures that they gave us here, seeing that we are doing the balance sheet at this date. Right? So we're moving forward because we're focusing on format here. So the balance sheet is broken up into our fixed assets first. We usually sum that up, right? We get 163,400. The next part of our balance sheet is going to be our current asset section. Now, current assets is usually made up of our stock, and this is usually the closing stock. Right? After stock, we have debtors. Right? And from our debtors, you will subtract any bad debts that were written off, as well as our provisions for bad debts. Right? These two things, we would adjust our debtors figure with bad debts that were written off. Those are debts that we have deemed irrecoverable. We're not going to get these back again. So no, it doesn't make sense that we continue reporting that as part of our outstanding debtors figure. And then we're going to provide for our bad debts, right? We'd always subtract that amount as well. After that, we will have, if we have any accrued expenses, which we do, sorry, not accrued, prepaid expenses. Accrued would go in our current liabilities. We list prepaid expenses here under our current assets. And if you remember from last week, our prepaid expenses, if you go to the working, I believe was electricity. Electricity was prepaid $2,000. You remember that from last session? Electricity was prepaid $2,000. So I'm going to make a note of that here. Right? Why am I putting this inside of my current assets? Because this is a form of where we are owed, if we're talking electricity, by our electricity service provider. We have paid for services of electricity that we have not yet used. So they are debtors to us. They are owing us electricity service. So if I pay in advance for next year's electricity bill, I've not yet received that bill, right? I've already covered or paid for electricity that I have not yet used. That's in the future. So this is why I need to record it as a current asset, because I am actually being owed this service. Right? Give me a thumbs up if you understand that. Good. Right? So we have stock, we have debtors, we have our adjustment for debtors, we have prepaid expenses. Then we could go to bank, and finally cash. So this is your lineup for current assets. You usually have your inventory, you usually have your debtors and the adjustment for debtors, right? Then you'll have your prepaid expenses. In some instances, instead of listing these out here, some books or some teachers may just make the adjustment in a bracket here. They take the total debtors figure and subtract your bad debts or provision for bad debts, right? I tend to prefer to show it so that we could actually see what those figures are. Make sense? Everybody all right with that? Yes? Good. So our closing stock figure, I'm going to put in these figures, would have been 74,210. So we have 74,210 for closing stock. And just like last week, you know, I use these columns. Some of them are like tally columns. So for example, with the debtors, right? I could do my tallying in here first. 61,400 minus my bad debts, 1632, and our provision for bad debts went down. I remember that last week, the provision for bad debts was reduced to 1250. In my balance sheet, I am not putting the reduction. Remember, I told you last week, we put the reduction or the change in the figure inside of the profit and loss. In the balance sheet, we are putting the entire figure, right? Just like with the provision for depreciation, and not just putting this year's depreciation, but the total depreciation. So these figures, if I subtract here, let's see what we get. 61,400 minus 1632 minus 1250, 58,518. Right, so I'll bring it into this column because this is what I'm going to be adding to my closing stock. Prepaid expenses, we said was $2,000 for electricity. And my bank figure, any bank figures? No, just cash at bank, so we don't have cash in hand. So cash at bank is 6130. No cash in hand, yes, no, no cash in hand. Right, so we use this, we use this. I don't need this figure. We use this, we use this. Right, so we're looking good so far in terms of our assets. Once I have the total current assets, I will add these up. Right, so let's add that up. We have 74,210 plus 58,518 plus 2,000 plus 6130. That's 140,858. Next, what we will do is we need to subtract our total current liabilities to get what we call our working capital. Now, the working capital is an important figure that we should include in our balance sheet because it tells the readers of the financial statement of the balance sheet how liquid the business is, meaning how well its current assets can cover its current liabilities, how well the cash values or cash equivalents they have currently could cover their immediate or short-term debt, right? So current liabilities include things like our, to make some space. Current liabilities include things like our creditors, as people that we owe, and any accrued expenses, which I believe was salaries and wages, and something else. Office expenses. Right? And that's it really for current liabilities. Current liabilities are anything or any item that we need to cover or pay, right? Or we owe for and needs to be covered under a year or less, right? Short-term debt obligations. So going back to our balances, our creditors figure is given here. I can now take it off 26,590, right? Again, I'll use my tally column, 26,590. Accrued salaries and wages. We had 720 for wages and 215 for office expenses, right here. right? 720 and 250. Everybody with me so far? 26,590 plus 720 plus 250. Now, that figure of 29,463 is what we will get when we add those current liabilities together. 29,463. We will subtract that from our current assets. The difference between my current assets and my current liabilities is going to tell me how much working capital I have. Right? Now, what I'm going to do is that working capital figure that I'll get, I'm actually going to add it to my assets to the top end. Right? So that figure is 148,508 minus 29,463, 111,395. Right, so this is going to provide my net assets. 163,400. So 274,795. Right. Now we will subtract less long-term liabilities. These are things that liabilities are long-term liabilities are those that we have to pay for in the long term, more than a year, 2 years, 3 years, 4 years, 5 years. And these usually fall in the category of loans or mortgages. So we have loan from P prints. So P prints or P price? Prints. And this is in the amount of 65,000. So 274,795 minus 65,000. 209,795. Right now, this should be the top part of my balance sheet. Now, there's something else I want to point out to you, right? A balance sheet is basically our accounting equation. Everybody remember the accounting equation? Please tell me what the accounting equation is. Anybody? Anybody remembers the accounting equation? So when we just start a business, we have assets. These are the things that we own. So let's say I'm very good at making ice cream and I want to start an ice cream business. I custom making ice cream at home, so I already have ice cream machine and I have ingredients. I have essence, I have whatever flavors that I'm going to be making. If it's coconut, right? I have the basic stuff. My assets is my capital. That's what I have to start the business. Let's say I also have some cash, right? So everything that I own is equal to my capital. That's what I'm going to use to start the business. But I can't run the business out of my home. Probably I live in a residential area and you can't sell things there. So I want to go to a park where I could sell the ice cream, but I need a ice cream cart or I want to get a portable stand and a generator. To do that, I don't have enough finances to do that on my own. So I'm going to approach my bank and they're going to give me a loan to purchase the cart and generator and what I need to sell my ice cream in the park. So they give me the loan. And that's going to cause me to have liabilities now. And in giving me the loan, I get some more assets. So my assets go up. So in our business, this is what basically what we are reporting. Our assets that we own is our capital. It came from the capital that we invested in the business, along with loans that we may have accessed or things that we would have borrowed in order to acquire more assets. So assets is equal to capital plus liabilities. Does that make sense to everybody now? This is the accounting equation. It's important because this is what the entire foundation or concept of accounts is based on. And it's basically what your balance sheet is reporting. Now, we could, just like in math, move things around and change the subject of the formula. And the balance sheet, or the one that I just did actually, I have taken my liabilities and reported it together with my assets. Everybody here, you guys are doing math, you're doing elementary or basic algebra. If I take the liabilities and I move it across on this side, instead of it being plus, when I come on this side, it's going to be minus. Everybody agrees with that? Give me a thumbs up if you agree with that. Makes sense, right? Good. So if I go back to that balance sheet that we were preparing, look at what's happening here. I have my assets. There's fixed assets, there's current assets, and I am subtracting from it current liabilities. Look at this here. I am also subtracting from it long-term liabilities. And when I do that, if I take my assets and I minus my liabilities from it, that is equal to what? Capital. So the next section that I'll be doing inside of the balance sheet is what we call the financed by section. So we're going to put a pin in it right here, right? This figure, 209,795. We'll come back to that. We need to make sure that when we work out our capital, we have the same figure, so our accounts is balancing. So the finance by section is dedicated to calculating our capital. And what we have would be our capital at start, less any drawings that was made during the period, because that means you would have taken money out of the business, right? After which we can add our net profit or net income. This is the income that we've made during the period. And that's going to give us our closing capital. Now, what should happen ideally when I put the figures into here is that my closing capital should be equal to this 209,795. Let's check it and see if that's the case or if we need to go and do some check boxes, see if we missed anything. So capital here, 186,800. See that? 186,800. You see from that, we need to subtract drawings. Drawings is 60,000. And that's what, 126. Add net profit. Now routine net profit above here, 81,565. $126 plus 81,565. 27565. Right, so we have a difference between my figures of, let's see how much our difference is. 29795 minus 27565. 2250. So somewhere along the line, we do our prepaid expenses. We missed something, or our figures would be off for that amount, right? Usually that's how we'd approach it if it is you have outage, right? Sometimes that happens. May have been something that I transpose. It could be the question, right? Could have been something with our working. Right, I'm not gonna get into it right now to try to go and identify the error. But ideally, this is what your format for your balance sheet is going to look like. Fixed assets, current liabilities, working capital, right? That added to my total fixed assets. Subtract our long-term liabilities. That gives us the balancing figure for our top half of the balance sheet. And then next we will do the finance by section, which would usually involve our capital, drawings, and profit. All right. Our balance sheet is off right now by 2030. If we identify where the difference is or where the error could have been, our balance sheet would balance. They should both have the same figure there, and we balance the balance sheet. All right, everybody understand the format of the balance sheet? Just give me a little thumbs up if you do. Raise your hand if you don't, and you want me to just recap. All right, so everybody's good. Excellent. So we're gonna look at another example with our profit and loss on our balance sheet. So one sec, guys. All right. So can everybody see my screen? So I have another question here. Right. This one wants us to do our income statement. All right, let's take a look at this. Issa is a sole proprietor, meaning a sole trader, trading in hair products and accessories. For the year ended 30th April 2013, the following transaction reports on Issa's business were provided. We have gross income, right, 68,540. In a situation like this, we don't need to calculate sales and that type of thing. They've already worked out. This is equivalent to our gross profit. So we are literally just doing the profit and loss section of this income statement. Fixtures and fittings, right? This is our balance sheet item. We saw that previously. This is also a balance sheet item. This is my total depreciation. Delivery van, balance sheet. Provision for depreciation, balance sheet here again. Provision for doubtful accounts. This could go in our profit and loss section. Balance sheet, balance sheet, balance sheet. Discount received I don't think we talked about this in our last question. We talked about carriage inwards. We talked about discounts allowed, right? Sales discounts. Discount received. When we receive a discount, it's like, let's say we're supposed to pay $4,000 worth of goods. We got invoice for this amount, right? For purchases. So we would have allocated money to pay this $4,000 worth, right, of goods. Let's say when we go to make the payment, we only had to pay $3,500. It meant that there was a savings of $500. How are we going to account for that? If we would already receive an invoice for $4,000 and then on making an early payment, we receive a discount of $500, this amount is a form of cost savings. And for that reason, what we do is we add it to our gross income. Why is the opposite of an expense? Think about discounts allowed. When we give a discount to a customer, we should have received $100 for a product, for goods. And we give them a discount and we take 90. We kind of going in the expenses by $10. So if the opposite happens for us, and we were supposed to pay $200 and pay $150, then that's a form of earnings or savings for us. So we add it to our gross profit or gross income as opposed to subtracting it as what we will do when we allow a discount and cause expense to ourselves. Everybody understand now? Yeah? Nice. So bearing that in mind, what we're going to do is we're going to add this to our gross profit, right? And this is also a profit and loss item. Creditors, balance sheet, rent paid, profit and loss, wages and salaries, profit and loss, utilities, profit and loss. Notice my approach to the question. I went through the entire statement and I identified which figures are going to go in my income statement, which is going to go in my balance sheet. Then I move down to the notes. Inventories at the 30th of April 2013. This is my closing inventory. Closing stock. This is going to go in my balance sheet as well. Provision for doubtful accounts of 10% of outstanding receivables is allowed. We have to calculate this and we have to use this in our profit and loss and balance sheet. Right? Depreciation is to be provided. We have to calculate this. We have to do this in our profit and loss and balance sheet. Profit and loss and balance sheet. Now the calculation or the figure reported in the profit and loss will be different from that of the balance sheet. We saw that earlier on. In the profit and loss, we're just reporting what the depreciation is for the current year or current period. In the balance sheet, we have to report what the depreciation was for the entire life of the asset. Annual rental cost, this is an expense, so we'll put this inside of the profit and loss. 200 was due for utilities, so we need to make an adjustment, right? So utilities. So just make a note here, plus 200. By doing this, it's easy for you to draw up your income statement. You're just going to list out what your different figures should be, right? Because you'd have identified here and then you do your working, right? So that's my first step. My second step is doing my working. Usually this will be things like provisions and things like that, right? So let's go do some working with provisions. One, provision for bad debts, right? We're talking here 10% of outstanding receivables. So 10% of current debtors, 10% of 3,200 is 320. Our previous provision was, look at it, 500. right? So right, so if it was 500 previously, we had a reduction of 180. So this we have to add, since it's a reduction, to our gross profit and gross income means the same thing, right? So don't let them confuse you. Everybody understand why we added? It's just like the example that we started with last week. You remember that, right? Yeah, everybody good? Okay, good. Part two, let's look at depreciation. Fixtures and fitting is 10% by the straight line method. But I like to do straight line method because less calculations. All we have to do is just find, how much is it? 10%? 10% of our cost of fixtures and fittings, which is 9,000. No problem. We're wrapping up shortly. I'm just gonna finish the working and I'll probably leave this with you guys to complete. Right, we're gonna finish in a couple of minutes. So this is my provision for depreciation figure. Delivery van 20% reducing balance. So remember what I said with the reducing balance method. You need the cost minus depreciation to date to give the net book value, and that's what you're going to find the percentage of. So the delivery van is 12,000 and the depreciation to date is 2360, 2,360. 12,000 6 11,840. 9,840. So this is the net book value of the van. So I have to find 20% of that to get my depreciation for the van. And so multiply by 0.2, 1928. So you see what we're doing? We're working through the question and we're identifying everything that we need in order to prepare our profit and loss account. Right? Here we don't need the trading part because they already gave us our gross income. So let me just get started, right? And then you're going to complete this as part of your revision for homework. Right? So you can see here profit and loss account. For year ended, and you put in the year ended 30th of April 2013. You put the name of the business, ISA, and you start with your gross income. Remember, we have to add our discount received. And then we're going to start subtracting our expenses. Right, so you could go through this and you'll see all the expenses. You have provision for bad debts. Oops, we forget that we had to add because we had a reduction. But we went from 500 down to 320, so we have to add that as well. Yeah? So what we have is actually provision for depreciation. And you list the delivery van. And what was the other one? Fixtures. Right, so we dealt with this delivery van, fixtures. We have rent, wages and salaries, utilities. Don't forget you have to add 200 to this here. Okay. Annual rental cost as well too. 6,000. Rent paid, look at this. 6,500. So rent has to be 6,500 minus 6,000. Well, just have to remember, we don't need to minus anything. Just have to remember to use 6,000 here for rent. Because that's the amount that's due for the year, not the extra that we paid here. So you have to remember to minus that. Okay? Everybody all right with that so far? So this is your template that you'll use for this question. Is it easier now that you are approaching the question using this methodology? Identifying the figures, doing your working, so you know exactly where everything is going to be. Is it? Yes? Better for everybody? All right, excellent. All right, guys. So I'm not going to keep you because I know everybody's preparing for exams. I don't want to run too late and you have school tomorrow. So I'm going to wrap up here. The session was recorded, so I'll just get uploaded to YouTube.